Welcome to Capital Link's Trending News podcast series. In this podcast series, we have the opportunity to discuss with company management on recent news and announcements that they have made. I am Nicolas, Bornozis, president of Capital Link, and we have today with us Mr. Moritz Fuhrmann, the Chief Financial Officer of MPC Container Ships listed in Oslo. Our discussion is going to touch upon the company's Q2 2023 recently announced results, but will mainly focus on MPC Container Ships development, strategy, and the container ship sector outlook. A quick reminder of our disclaimer that our podcasts are provided purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and of course, Capital Link bears no responsibility for them. And I'd like to mention that Capital Link has the opportunity, the privilege to work with MPC Container Ships on investor relations. MPC Container Ships is a leading container tonnage provider focusing on small to mid-sized container ships. Its main activity is to own and operate a portfolio of container ships serving intra-regional trade lanes on fixed-rate charters. At the end of June 2023, the group's fleet consisted of 63 vessels with an aggregate capacity of approximately 137,000 TEU. The company shares, as I mentioned, trade on the Oslo Exchange under the ticker MPCC. Moritz, welcome. As I mentioned, our discussion today will focus primarily on company development, strategy, and sector outlook. But I think let's start with the recently announced results. You announced the Q2 23 results on August 22nd, and that was a very strong quarter, despite the fact that the container ship market has gone through a period of softening. Despite that, your results have been quite robust. So would you like to elaborate on your results and also on what drives this performance?
Sure, very happy to do that, and obviously thank you very much, Nicolas, for having me. Yeah, needless to say, we are very happy with the financial performance of the second quarter in 23. I mean, the net profit has been coming in north of $100 million, earnings per share around 23 cents. Again, average TC rates close to $30,000 per day. And that is also one of the reasons why the financial performance is so solid, despite, and you mentioned that the market is sort of normalizing relative to the last 2 to 3 years, is still have a lot of legacy contracts with very decent names, decent charter rates, enabling us to post those profit numbers. And also what we were focusing right now a lot on is the operations of our ships. So we were able to improve the utilization, and a lot of emphasis is being put into operations of the ships and trying to maximize the contracts that we have on the vessels. And basis the very good performance, the board has declared another recurring dividend of $0.15. So in normal numbers, we talk about $66.6 million. So year to date, that brings us to a total dividend being distributed to shareholders of $230 million. And I should say that the Q2 dividend is being paid out towards the end of September. So including that, we are around $230 million.
So, Moritz, you mentioned that on one hand, you obviously have optimal operational performance with high fleet utilization, but also you have a number of very strong legacy charter coverage. How can you elaborate, looking ahead, on the charter coverage that you have secured so far, and how does this impact, or how does it translate into cash flows and profitability?
Yeah, sure. I mean, obviously we can talk about the rest of 23. So we're one of the companies that is putting out a guidance on revenue and EBITDA. So we have raised the revenue guidance to 675 to 690, and the EBITDA to 490 to 510. This is for the remainder of 23. And looking at 23, we're already covered 94% in terms of open days. Going into 24, we are covered close to 60% of open days, and 25 we still have a coverage of close to 25%, and that's on an open day basis. If you were to look at it from a relative perspective and taking into account the revenue side of things, so again, the legacy contracts, they are running on charters around the mark of $30,000 to $35,000 per day. And if you were to add open vessels at current rates, then on a relative basis in 24, the coverage would increase to 75%. So you know, going into 24, it's quite a comfortable position to be in from an MPCC perspective, especially, you know, looking at our backlog from a revenue perspective. The visibility is quite clear. So you have an average duration on the backlog of 1.8 years, so close to 2 years, with very decent names in the industry from a credit perspective. So around 85% of our backlog is with the top 10 liner companies, but also cargo-backed operators.
Well, clearly the credit quality of your counterparty is key, especially given the legacy contracts. So that's a very good point that you raised. During your conference call, you mentioned that you focus on maintaining prudent capital allocation and enhancing long-term shareholder value as you remain in an ideal position to balance strategic and selective fleet optimization efforts with continued accretive shareholder returns. I'm quoting from the call. So can you elaborate how do you ensure that your operational strategies align with your capital allocation strategy to achieve the best financial outcome?
Yeah, no, it's a valid question, and obviously, just starting to say that I tend to believe that we are perceived positively by the investor community because we walk the talk and we continue to distribute capital or return capital to shareholders. So going forward, we will certainly continue to pay the recurring dividend. As you know, historically, we had two types of dividends. One is the recurring, and the other one is the event-driven distribution. You know, whenever we have vessels that we sold, we could, based on our policy, distribute between 0 and 100%. And I think historically, on average, we have distributed 2/3 of those feeds back to shareholders. And this time around, the board has decided to, because there has been a few vessel sales in the second quarter, to not distribute event-driven distributions, so to keep the money on the balance sheet. And I think now we need to define what does operational challenges means going forward, going into 24. There's a lot of dry dockings that are coming up. One thing that why we want to bolster the liquidity cushion on the balance sheet. But the second thing is also the market outlook is somewhat unclear. So we think it's rather prudent to sort of beef up the liquidity position on the balance sheet, at least for the time being. And, you know, if the market develop more positively than what we think, then obviously we still have the ability to distribute event-driven distributions to shareholders. So I think that's one thing. And then we have also, and we talked about it before, we believe that 23, 24, and 25 could be very interesting for us as MPCC in terms of fleet optimization and fleet renewal. We have acquired a few ships this year, and the question is, how do you fund those acquisitions? You know, when you from the operational business, when you have a tendency of distributing most of the capital. And the answer is simply for us, we can use the balance sheet. We have a very low leverage on the balance sheet. We have a lot of unencumbered ships on the balance sheet, and there's obviously the potential to incur some leverage on those assets and raise some cash to be able to acquire ships at attractive levels, obviously, going forward.
Well, you took me to fleet renewal. I was planning to ask you about the dividend, but let's focus on fleet renewal. I think fleet renewal is a compelling topic, given green shipping on one hand. I think the situation with the age of the fleet in the segment you operate. So, and you've been quite active in terms of fleet renewal. Can you elaborate a little bit on your S&P activity, on your new building activity, and how you approach the fleet renewal aspect?
Yeah, it's again, as just mentioned, we believe it is. I mean, we're not at historical low levels where you can buy dirt cheap vessels, but we still believe it's an opportune time to be active in the S&P market. And you mentioned yourself the regulatory pressure that is coming up in the near-term future is almost forcing us to be proactive when you know, renewing the fleet. The fleet on the water that we have is between 15 and 16 years of age. Trading very well, they're well maintained, but you know, with the CII regulation being introduced, but also for vessels trading in Europe with the EU ETS trading scheme, there will be more requirements and demands by our customers, and obviously we want to stay relevant, and we have a few new buildings, but they're only coming in 24, and we certainly want to stay relevant as early as possible, and signal also to our customers that, you know, we are proactive, we renew the fleet, and we will have an attractive offering to you as a customer going forward. And obviously, historically, when you assess a purchase a transaction, you look at, you know, what's your return, what's your entry point, what's, you know, is it accretive from an EPS perspective, what's your de-risking. But needless to say, there's one more ingredient now, which is also how efficient is the vessel going forward, and how compliant can the vessel be from now to 26, but also 26 going forward, and 26 being the date when the CI being or becoming even more stringent.
So, but in parallel, besides the fleet renewal through new builds, you have also embarked on retrofitting. So maybe I think you can mention a little bit about your efforts in that area.
Yeah, certainly, and you're right. We have mentioned that specifically in our Q2 earnings call, and for the time being, I think it's fair to say that the retrofitting measures that we have done is around, let's say, silicon paints, and you know, during the contractual dry docking period, but also other smaller measures that can be done without dry docking the vessels. And I don't want to go into too much detail, but I think the more relevant part, and that's something also for 24, is that we have earmarked a number of vessels in our fleet that we think it's worthwhile to retrofit with the larger measures, and that means retrofitting the bulbous bow, retrofitting propeller, introducing fin propeller caps and hull fins, Mewis ducts, etc. So it's a capital intensive exercise for sure, but interestingly, we are now in a position to have a strategic dialogues also with our customers, especially on vessels that are on longer term charters, where also the charterer has a relatively strong benefit if we retrofit the vessels, because obviously they're responsible for procuring the bunkers, and if the vessels are operating more efficiently, then there's also quite a big cost saving element in there for liner companies. So we have earmarked a few vessels, and we will go ahead. We have some interesting dialogues, as I mentioned, with liner companies to at least split some of the costs, that not everything is being borne by MPCC. And you know, with that, we are being able on certain vessel types to improve the efficiency by between 15 to 20%, which is quite interesting in my view. So you can all of a sudden, a vessel that has been built during the Lehman crisis, you can almost level it with a vessel that has been built in 2013, 14, 15 in terms of carbon emission footprint.
You took me into the next question. You have almost answered it. On one hand, we see the pressure coming from the regulatory side in terms of green shipping and so on. But on the other hand, which I found noteworthy, is you have your customers essentially putting more emphasis on fleet optimization, green shipping, and so on. So can you elaborate? I mean, do you see more demands coming from the customer side in this area?
Yeah, certainly. I mean, and on the customer side, it's quite clear right now to see different strategies, and especially talking about the 2M alliance between Maersk and MSC. maybe that's also the reason why the alliance is not in place anymore. But those two companies, for at least for us, it's quite clear that they have different strategies when it comes to the green transition, and Maersk being the one putting more emphasis on retrofitting and ordering fuel efficient ships relative to MSC, who is incredibly active in the second-hand market, also on the new building side for sure, but also in the second-hand market and willing to buy older ships taking to the fleet. So there you can clearly see a shift, but also what we see in discussions that we have with our customers. I mean, historically, the discussion was only with the chartering department. We have a ship, you talk to the chartering department, and you get a rate and duration. That's it. But these days, it's much more complex. You all of a sudden you have discussion with the chartering department, with fuel procurement, with sustainability, with all those peoples being involved, and the discussion becomes, at least from our perspective, more levels, so more strategic, which obviously is helpful, and that not only leads to retrofitting project, but that can also lead potentially to partnering up with the liner companies on certain new building projects, for example. Maybe a bit more relevant for us because we are the first tonnage provider that has been ordering dual-fuel methanol vessels. So there is expertise in-house in MPCC that could be valuable for a liner company, and hence the liner companies being willing to have a more level discussion, whereas in the past it was maybe a bit more top-down. But that's also clearly a shift that we see in the discussions that we have with our customers.
And I presume that older ships that do not live up to those expectations, clearly they will be penalized commercially. Now, let me go into capital allocation and dividend. You have paid a regular dividend so far in 2023 of 231 million. That's a lot of money. And I think it translates into a yield so far of 34%. I mean, that is a massive amount. So in terms of dividends, is this policy sustainable? I'm not asking you to give guidance, but clearly you have a very specific, I think, policy when it comes to dividends. Maybe you can describe it to us and tell us what is in store regarding this policy.
Yeah, it's a good question, and it's not only 34% since beginning of this year. It's more than 50% since the start of 22. So if you go back one more year and assume you have bought the stock in January 2022, then your return would have already been more massive. And I think it's a valid question. We pride ourselves again to be walking the talk, and we are committed to the recurring dividend. And as mentioned before, we also have the event-driven dividend, which we are sort of holding back for the time being a bit more, as we want to retain some more cash on the balance sheet. I think what is interesting to observe if you look across the peer group is that I think it's fair to say that we are the ones with the clearest dividend strategy, returning capital to shareholders. You have other names that are rather than returning capital, buying into dry bulk. You have other names simply not having such a high dividend policy and simply retaining some cash on the balance sheet. But from a valuation perspective, I think it's quite clear that we have sort of the smallest discount to NAV relative to some peers. So from our perspective, it is appreciated by investors that we're paying back so much money. Towards the end of the year, the dividend yield will probably be in excess of 34%. So much I can say. Is that sustainable long term? No, it's not. But obviously, it also needs to be seen in context with the backlog that we have, right? So right now we're in the harvesting period, and the backlog or the contracted cash flows that we have and the rate levels that we have are significantly above the current market level. So we are naturally not in a position right now to continue adding to the backlog. So yeah, it's harvesting period. And again, all the major shareholders with whom we are in a frequent dialogue, they are in appreciation of what we do in terms of capital allocation.
obviously, as you mentioned, this dividend is coming out of contracted revenues. So you are in the harvesting period, as you mentioned, and very correctly so. You kept the event-driven cash on the balance sheet. I mean, you've already distributed a lot of money to the regular dividend. So any other priorities in terms of your capital allocation?
Yeah, we have been, I mean, obviously, yes, capital back to shareholders. One, two, deleveraging the balance sheet. And, we're now down to a 13% leverage ratio on the balance sheet, which we obviously believe is quite prudent. Going forward, it might increase again because we're looking at a few things from a debt perspective, raising some cash, or introducing some flexible debt instrument on the balance sheet. Being able and have the flexibility that we need next to dividending out cash to shareholders to act opportunistically in what will probably be a very interesting market from an S&P perspective.
But it's interesting to see that all this time you've been able to use the cash flow to delever, to give back to shareholders, and also to fund growth. So, I mean, you mentioned you have a number of unencumbered ships, which provides with additional capacity if you want to grow further. So now going into the sector, on the supply side, I think the supply side is something that we know, fairly easily, fairly well. What is the situation in terms of S&P activity, in terms of new builds, in terms of the age profile of the fleet in your segment?
Yeah, maybe we can start with the S&P activity. And the market has seen historical high liquidity in the market, obviously in 21 and 22. The market has cooled off, as we all know. But good thing to note is that we still have a healthy level of liquidity. Yes, it's driven by a few distinct names, MSC being one, by far the most active buyer still in the market and adding to the liquidity. And I think, year to date in 23 on average, and not only talking about our segment, talking about the entire container market, I think around 15 to 20 ships each month changing hands. And if you put that into perspective, so second half of 22, it was only 15. So, the liquidity is actually not that bad. It's higher than the second half last year. Obviously, it's much lower than 21 and first half 22, but it's still holding up. But what you also see now, and which is not surprising, you see a differentiation now again between good designs and less favorable designs, from a commercial attractiveness point of view, and that's quite common when the market normalizes, as opposed to 2021 and 22, where regardless of the type of the ships, you could just charter it out to a liner company for same rate and same duration. So you can see now that the market is sort of normalizing again, that people are willing to pay more for a decent design, and obviously less for not that favorable design. And from an order book perspective on the supply side, as you mentioned, also an interesting discussion, and a discussion that we very often have with our investors, because obviously everyone is very focused on this 30% order book number that everyone sees and it's in everybody's mouth. But if you drill in, it's obviously quite obvious to see that it's heavily skewed towards the larger sizes. So I think 85% of the entire order book in TEU terms is 8,000 plus TEU. Specifically, the 12 to 17,000 TEU segment has an order book of close to 70%, which is daunting, no question. The good thing is, hopefully, that it's only been ordered from the operators themselves. And hopefully they know how to use those going forward when they're being delivered. But looking at the sort of MPCC focus areas, which is the 1,000 to 3,000 TEU and the 3,000 to, let's call it 8,000 TEU segment, the order book is around, I think, 15 and 18% in those two segments, which is comparatively low to the larger sizes. It's slightly higher than the last couple of years, but from our perspective, it's a digestible number, especially in what is our sort of main segment, which is the 1,000 to 3,000 TEUs. There's roughly in total talking about total number of ships, 300 ships on order, and now taking a view on the age distribution of the fleet, which is also quite interesting, right? So in our segment, in that 1 to 3,000 TEU segment, you have in total roughly 2,200 ships, of which again 300, which is equal to the order book, is around 20 to 24 years, right? And on top you have around 250 ships, which is older than 24 years. So I think those numbers are quite impressive, and that, from our perspective, will lead to further scrapping going forward, which is just natural, right? You need to replace those. We haven't seen that many scrappings, obviously in the last years, but also year to date, because the market is holding up. I mean, you can still fix at decent levels, and why would you scrap a ship if you can still earn money? But going into 24 and 25, we think it's inevitable that we will see more scrapping, especially in our specific segment. So that's why we believe that the order book can be absorbed, hopefully quite smoothly over the next, let's call it 15, 18, 24 months. And at the same time, and now talking again about regulation CI, you will need to see, especially on the older ships, you will need to see a slowdown in speed in order to be in compliance with CII. So we have been running some numbers. Obviously, that's only internal research, and don't take it for granted. But basis our assumptions and our models, there could be a supply side implication in the feeder segment of 5 to 6%, simply by reducing the speed by 1 knot. So that's also quite an important factor. And if you throw everything together, again, the feeder order book, I think, is manageable. Question remains on the larger sizes and to what extent you will see a cascading effect. So jury is still out, but again, as I just mentioned, the market is still holding up. Yes, charter rates have been coming down, but still at levels that from our perspective are okay.
But that takes us to the demand side. I think clearly on the supply side, the picture is fairly straightforward, so to speak, or at least a lot more straightforward. On the demand side, we have global uncertainty regarding the macroeconomic developments, but still there is a big difference, I think, in the demand dynamics of the larger vessels versus the intra-regional level that routes that you are focusing on. So maybe you can describe to us how you are seeing these intra-regional routes developing.
Yeah, that is obviously always the most difficult question to answer. Everybody can model out the supply side, and the tricky question is the demand side. So what have we seen over the last weeks and months? Interestingly, we have seen a gradual increase in freight rates, being reflective of demand, hopefully. Remains to be seen how sustainable that is. The overall news is rather adverse in terms of global macroeconomic picture. But now in terms of intra-regional trades, what have we seen? We have seen a decline, yes, not as steep as in the main lane trades, east-west, for example. And if we look at the 2 major inter-regional trades, being Asia and Europe, in Asia we have seen a slight decline, and probably driven by the Chinese economic activity, but also some typhoon season. So there was a smaller decrease. But also in Europe we have seen weaker traffics. And the question obviously remains, what's going to happen going forward? In intra-Asia, you already see that more and more vessels coming into the market, coming open. So from a supply side, talking again of supplies, but you will probably see some more supply side pressure in the intra-Asia trade, and intensifying the competition, and potentially leading to lower freight rates, remains to be seen. However, in Europe, our expectation is, and that is purely driven by the regulation that is being introduced, EU ETS, we're actually thinking that we see an increase in freight rates naturally, right? Because liner companies will hopefully try to pass on the higher cost that they will have to their customers. But I think just to mention overall, we believe there's a high trade growth potential, especially in emerging markets, which are usually being served by the feeder vessels, especially driven by economies with a catch-up potential. And then we also, we are quite active in the intra-Caribbean trade. There's also some growth potential. And interestingly, if you look historically and you compare the inter-regional trade growth with the mainland trade growth, the inter-regional trade growth has always been more resilient. And the growth that you have seen has always been stronger. Yes, there will be some dents, I would call it, in the growth, but the mean reversion will certainly be there. Yes, 24 will probably be challenging, maybe 25 as well. But again, from our perspective, the segment that we are operating in, both from a supply side perspective, but also demand side perspective, are certainly more interesting than operating in the larger sizes.
So we had coming to the end of our discussion. Any closing remarks that you would like to make regarding MPC? You're looking ahead, the market or the company development?
Yeah, no, it will be an interesting / challenging market 24-25, but I believe that we're quite well positioned. We have a strong EBITDA backlog of $900 million. We continue with our prudent capital allocation, so we will continue returning capital to shareholders. You mentioned yourself, year-to-date dividend yield of 34%, which will, with the next dividend being paid towards the end of the year, which will probably in excess of 34%, which is pretty compelling if you ask me. I think we have proven historically that we have a timely fleet optimization, and we're quite happy with taking in the 5 modern eco ships that we have acquired over the summer. We have a very strong balance sheet, low leverage. We will continue to have a lot of unencumbered vessels on the balance sheet, giving us a lot of flexibility. And last but not least, as we just talked about, I think despite the overall maybe negative sentiments on a container trade, which is understandable if you look at the order book and the overall macro picture, I think the feeder segment itself is incredibly interesting for reasons that we just talked about. And I think we're pretty well positioned to hopefully take advantage of whatever lies ahead of us.
And with that, I'd like to thank you for joining me today in this very interesting discussion. We had the opportunity to discuss with Moritz Fuhrmann, the CFO of MPC Container Ships, the Oslo listed MPC Container Ships. Moritz, thank you very, very much for this podcast.
Thank you, Nicolas.